Good morning, good afternoon, and good evening to everyone who has logged in. Welcome to our webinar on mobilizing private sector finance for infrastructure in Africa. I'm Mohammed Shuman from the Public-Private Partnerships Cross-Cutting Solution Area at the World Bank Group. I'm based in Washington, D.C., and I will be your moderator for today's webinar. This is the first of 4 webinars in a series jointly organized by the World Bank Group's Open Learning Campus and the PPP Cross-Cutting Solution Area. We have many people registered for this webinar from around the world. We are very excited to have you here. And joining us now from London to discuss today's topic are Mark Cockburn, the Director of Cambridge Economic Policy Associates, and Michael Obanubi, the Principal Consultant at Cambridge Economic Policy Associates. Mark and Michael will be presenting their research findings on the main constraints on the flow of private capital to infrastructure projects in the Sub-Saharan Africa. Following their presentation, we will have a short series of questions through which Mark and Michael can further discuss their findings with you. Then we'll open the floor to Q&A session with you, the audience, in which you will have an opportunity to ask our speakers about their presentation. So without further ado, Mark, over to you.
Unfortunately, you're probably just going listen to my voice. Michael is sitting next to me, but we seem to have a shortage of headphones. But if there are any specific questions for Michael, we can of course pick those up. So thank you all for tuning in. This is a project that we've been doing for the UK's Department for International Development over the past year or so. If we turn to the research brief, it's not a consultancy assignment as such. The aim has been, as far as possible, to assemble evidence to address a question that I'm sure is very familiar to a lot of you who work in this area, and that's whether the main blockage to flows of private investment to infrastructure in DFID-focused countries, particularly in Sub-Saharan Africa, are attributable to a lack of a pipeline of bankable projects or lack of the availability of finance due to issues associated with on the side of the providers of finance. So within those 2 areas, on bankable projects, we're looking at what are the main blockages to developing a pipeline, and are these upstream in nature, enabling environment, political commitment, etc., or more downstream in terms of the ability to put projects together, and what are some of the potential policy interventions that could be used to address these constraints. And then if we actually look at finance, the starting point is looking at what is the finance that is currently being used for projects that are reaching financial close, and then what are the principal barriers to increasing those flows of finance, both as regards international providers and local financial institutions. And then whether or not any form of public subsidy could help the provision of finance. We've also been asked to look at this question in the context of regional projects as well as national ones. So this presentation is very much a brief, I should say, summary of some of the main findings. There's a lot more detail that underlies what's being presented, which will be available in the reports, which I understand DFID just published yesterday. So in terms of what our focus has been on, it's been very much on the whole on private debt and equity rather than on finances provided on a sovereign basis from international lenders. We've been very much focused on PPPs and to a lesser extent projects where there may be principally private projects, but where there's a PPP, a public sector angle to them. We've excluded purely public projects. We've also concentrated on our research on countries in DFID's focused countries in Sub-Saharan Africa, and we have used India along with from South Asia as something of a comparator in certain contexts. We've also been very focused on traditional economic infrastructures. We haven't really looked at some of the more social sectors, and we've also been looking at projects of a reasonable scale. We haven't been looking at say, for instance, small off-grid solutions. In terms of what our research has covered, all of these are provided in much more detail on our website. We began with a systematic literature review looking at what had been written on these issues. We then, in terms of putting together a database, from sort of 2010 to 2014, we took the World Bank's PPI database as a starting point and tried to fill in some of the information as regards sources of finance for those projects in DFID's focus countries. We then supplemented that with much more specific country studies in Nigeria, Kenya, Ghana and Mozambique, where we interviewed a series of different stakeholders. We also did quite detailed desk research on South Africa and India, particularly to show what's been happening there and how they have dealt with a number of the challenges faced by some of the other countries in Sub-Saharan Africa. We then looked on the supply side, did some research on flows of finance from OECD countries to Sub-Saharan Africa. And then on the regional side, we tried to focus down on some of the specific additional barriers that regional projects faces. And finally we did a policy options paper that really tried to build on what's been observed at the moment, together with some of our own ideas, which whilst may not be full solutions, are some of the things which we think might be investigated in the future and taken forward as more developed policy options. So if we actually begin with what's happening to projects now, the graph shows, on one hand, it shows maybe a slightly disappointing picture. If we look at the period 95 to 2004, there was a much higher annual flow of private finance into projects being financed in DFID's focus countries in SSA, which includes South Africa, largely driven by telecoms. If we look at the past decade, that average flow has fallen somewhat from what it was previously, although there's a much greater or better balance between different sectors. In particular, there's been, since 2005, a considerable increase in energy sector projects, but a lot of that, even if you look at these sectors, most of that capital is actually flowing to IPPs or electricity generation. There's also been a significant increase in financing for renewables generation projects. Again, just looking at what's been happening, and these figures are looking at a subset of that 2005 to 14, the 2010-14 figures, where, as we'll come on to, we've done more detailed research on financing. And what's clear is that, it's a significant concentration of activity in certain countries, particularly in transport. Nigeria has tended to drive that principally through its ports sector program, whereas in telecoms, again, Nigeria has been a big player. And then some of the other telecoms transactions have tended to be in countries that have been perhaps slower to reform. We don't have an energy breakdown on here, but something like 50% of the energy projects are accounted for by projects in South Africa, which are largely South Africa's renewable IPP program. some of the other observations on bankable projects, or what can you draw from some of the findings. And I think the first is that you tend to see more activity where there have been government origination of projects, particularly as regards programs. So I've mentioned the South African Renewables Program, Nigeria ports, but also I think within this you could also look at Kenya's IPP sector as being a good example of this. These kinds of programs have tended to rely on support for project preparation and financing from key donors. World Bank, for instance, as regards Nigerian ports and Kenyan IPPs, whereas the AfDB has been quite active in supporting Kenya's geothermal program. I think an important point on financing, and remembering that where we've looked at detail in countries, the case study focus countries, Kenya, Mozambique, Ghana, and Nigeria, have tended to be arguably countries that are on that lower income, middle income cusp, and therefore have seen more activity. But even here, we've seen a lot of reliance in one way or another on the World Bank's or even African Development Bank partial risk guarantee product, including 5 of the 7 IPPs in Kenya and 4 out of 4 energy sectors projects in Nigeria. So I think that's just quite important to bear in mind. So if we then turn to some of the constraints, again, those of you who've worked in the PPP areas historically understand the considerable amount of focus on creating an enabling environment for PPPs, which is often focused very much on developing legal, regulatory frameworks, institutional capabilities, etc. I think what we picked up particularly from the country studies was that it wasn't, even before you get to some of these more tangible activities, there is a basic challenge of actually getting users to be willing to pay for the provision of infrastructure services. And this is not necessarily just to do with PPPs, it's also across the piece in terms of publicly provided services. And the implications of this is quite profound, particularly as regards some of the sectors where we're seeing most activity. For instance, as regards IPPs, we have a number of off-takers that are basically on the edge of insolvency, and that obviously creates significant problems for lenders who are concerned over the creditworthiness of such offtake. Also, when we've been looking at roads, things such as the Lekki-Epe Expressway concession in Nairobi, found considerable difficulty in being able to apply cost-reflective tolls. So, and this is really against the background of where affordability, which clearly is still a challenge, but arguably becoming less of a challenge on the back of high growth rates. So you could say that one of the starting points in terms of problems is that this is as much an issue of funding as it is of financing. And if you actually look behind, why is it that it is so challenging to create cost-reflective tariffs, what's driving this? I think that there is an affordability issue. There's obviously political resistance, but sometimes governments just don't want to put previously state assets into the private or PPP arena for a range of political reasons, including desire to retain control. And I think one of the big challenges that this creates is that some of these issues about political commitment to PPP and what's necessary of private finances to be attracted are much less amenable to traditional donor interventions of technical assistance, which we have used to help create some of the more tangible legal requirements and to build institutional capacity. If we look at some of the downstream constraints to projects, and here we're really talking about the capacity of the public sector to develop, originate, and develop, package its own projects. Clearly, finding the skills for those tasks is challenging. They're expensive. They're often not resourced properly. Government, as a result, government-originated projects are often not prepared in an appropriate manner. What's presented to market is not what lenders would see as a bankable package, complete with full required risk mitigation, security requirements. Often, we heard from potential bidders that a traffic study was presented, and clearly that's not something that is at that stage is bankable. And perhaps partly as a result of this, within Sub-Saharan Africa, there's still a significant, particularly in some countries, a very high reliance on unsolicited proposals. And these they can be done, particularly in renewable energy. There have been a number of transactions which have gone through, but they tend to be more opaque. There are often issues around where project rights where project rights have been established. And at a minimum, this, in terms of traditional financiers such as DFIs, this requires them to take extra time to understand that nothing untoward has happened. So as a minimum, funding and financing is slowed down, timelines extended, and I think as well the level of success we tend to see from this is that they're very much one-off successes rather than some of the programs of successes that we've referred to as regards Nigeria and South Africa. So what needs to take place to attract private capital? I mean, the message that we had coming back to us, particularly from the banks, was this is not a shortage of capital. It is a shortage of creditworthy opportunities. How do we fix this? And I think there are probably short-term and longer-term solutions to that. In the short term, I think we probably need to be realistic that a lot of projects will need varying degrees of guarantee support. PRGs are probably an effective tool as regards this, not least because they enable specific risks to be targeted rather than full credit guarantees, which a number of governments are still providing. They could also be extended where at the moment they're being used, particularly within the energy sector, but it's possible that they can be used within the transport sector, for instance, within availability structures, so say roads, which don't try and transfer traffic risk, but are really more focused on transferring performance risks, with government remaining the ultimate payee. Obviously, when IDA and ADF resources are used to provide the guarantee reserves, this can be a very cost-effective way of providing subsidy to mobilise resources. But in the longer term, if we are, to move to more viable opportunities, more standalone opportunities, longer-term policy reforms need to take place. Some of those, the obvious ones, are around cost-reflective tariffs and using subsidies very much to focus on the poor. One of the issues we'll come on to is that a lot of, at the moment, most institutional finance tends to want to look at assets with a performing track record rather than looking at greenfield risks. So again, that sort of raises questions about existing publicly owned assets and the extent to which they might be opened up to private finance, not necessarily through a full divestiture, but certainly a partial one. And then some of the wider sector reforms, such as creation of physical power pools as regards physical connections, but also as markets, to help address some of the single off-taker risks that a lot of projects are facing. So turning to finance, we spent quite a lot of time trying to assemble detailed financing information, not so much in terms of pricing, but largely just to see what were the sources of financing for projects. So the table that's shown looks at the information that we were able to collect. It's not fully comprehensive, but we feel we've got captured a significant proportion of finance. And for projects in DFID's focus countries, this excludes South Africa and telecoms, I should say, for the period 2010 to 2014. And what's quite interesting here is if we look at the debt that commercial banks, debt sourced from commercial banks, does appear to be overtaking that provided by DFIs. Although we should say that a lot of that is driven by two very large projects in Nigeria. Largely, as say 50, given the fact that I think in the past, over that period, something like 50% of financing flow to IPPs, and so IPPs generation tends to be undertaken on a project financing approach, which tends to dominate. I think one of what we've observed is that the project financing model, whether it be DFIs or banks, typically debt and equity, or particularly debt, will come in at financial close and then will be held to term. There'll be no recycling of that. Most of the equity is being provided by project sponsors rather than, for instance, private equity funds as such. And most of the debt is long-term FX, dollars, euros. There's not that much in these sectors, not much that's provided, longer-term debt that's provided by way of local currency. So if we look behind some of these figures a bit, the top left-hand graph just shows the pattern of DFI and commercial bank financing, and as we can see, this increase in finance by commercial banks tends to be something that's happened over the past couple of years. Interestingly, the banks who've been providing that finance are largely those with networks within Sub-Saharan Africa rather than international banks from outside, essentially exporting capital. So the international banks based outside of South Africa without operations there, typically providing something like 5% of the finance. If we actually look at which banks are actually providing that finance, very dominated by South Africa and Nigeria. And just as regards where the DFI debt is coming from, clearly EFDB and FMO, EIB and IFC are the largest as regards that. So in terms of barriers to increasing the provision of financing, there's not a lot of evidence to suggest that there is a supply side issue, at least when it comes to bank debt. It's much more an issue, as I've set out, of a lack of opportunities where lenders are prepared to extend credit. But I think if we start looking at local currency debt and finance from institutional investors, the story is slightly different. Most African banks are able to access long-term FX markets. They might not be able to all do it on the same terms because of differences in counterparty risk, etc. But there doesn't seem to be a lack of ability to access wholesale markets, those wholesale markets. However, in terms of local currency, not a lot of evidence of longer-term tenors. There's the odd exception, like the Lekki Toll Road. Normally, banks have been lending 5 to 7 years, and a lot of that has been to corporately financed telecoms projects. Obviously, the issue for this is, although banks are beginning to issue longer-term instruments for their own funding, there's still quite a reliance on short-term deposits and some of the liquidity risks that creates for them if they're seeking to lend for longer to projects. There's also a big, at the moment, clearly a big cost difference between raising, certainly in nominal terms, in terms of raising local currency, as opposed to dollars and euros, which are probably whose wholesale costs are historically low. There's also the issue with local currency that it can be very difficult to hedge interest rate risks for any periods of time, which creates a degree of uncertainty for borrowers. Now, if we look at mobilizing institutional finance, before we even get into issues of regulation and other constraints that are often mentioned, I think one of the immediate observation is that the actual current project financing model doesn't really create many opportunities for most institutional investors. Most, as we mentioned, most of the opportunities are in IPPs, and if you look at pension funds and insurance funds, etc., most of, apart from specialist investors, most of them are interested in operational liquid assets, not greenfield and illiquid ones, and that's really what, on the whole, is being offered to them in terms of investment opportunities. So, how do we actually open up opportunities for such investors? And I think a lot of this is about somehow or other creating refinancing opportunities rather than trying to bring people in at financial close for risks that they don't understand. One thing that might be worth examining as regarding this as the DFIs are clearly still big players in these markets, is whether or not it's possible to do more of a recycling approach where DFIs would come in at least during the construction period and then would seek to exit once the project had a track record and was operational. Obviously, how DFIs were rewarded, given the additional risks that they have to take to do that, is a much bigger question, and one that does need some consideration in terms of what they would require to be prepared to play that role. If we look at mobilizing local sources of finance, this is important because we are building up considerable exchange rate risks. Projects are all FX denominated. Often, somebody has to bear that risk, whether it's governments or whether it's customers. Unusual projects clearly would be reluctant to do so. So we're not necessarily talking about a need for full local currency financing, but at least there is a strong case for increasing the local currency financing component proportion of a project's financing. In an ideal world, we would, of course, seek to fully match revenues, the currency of project revenues and costs. Now, in terms of banks, it's not necessarily just, I think, addressing the credit issue is something all providers of finance need addressing. But in addition to the credit issue, there's clearly also an issue of liquidity and how those risks are addressed. What happens if a lender has a requirement for liquidity, over a 12 to 15-year period? Now, some of the potential solutions for that are provision of put options by DFIs, and I think they're already beginning to look at some of this, to look at the back end of loans where lenders are concerned about some of the provisioning requirements of Basel III. And there may be ways in which DFIs could play more of a market-making role. In India, IFC, for instance, is issuing local currency bonds, which are then lent directly to projects. There may be options in other countries around providing that finance wholesale to local banks who then on lend. So we don't have a perfect solution for this, but I think these are some of the things that we need to begin to look at if we are going to try and move away from complete reliance on local currency, on FX financing. Of course, one of the other ways of dealing with the currency mismatch issue is to create currency swaps markets, and the Currency Exchange Fund, TCX, is very active in this area and would like to get more involved in infrastructure provision, but at the moment it has I think a relatively small proportion of its business is involved with that. Looking at regional projects, a lot of these issues are the national issues, but writ large. Obviously, you're dealing with a much greater range of stakeholders. Trade-offs are very different. One country in a regional project may not benefit as much as another, may even arguably it may actually cost it something as well. So the cost-benefit may not be completely aligned. What some of the sort of challenges of who will sponsor these projects from the government side are also quite challenging in terms of financial and human capital. Picking the right vehicles to work with can be important. The World Bank has just recently issued a credit to the SADC Secretariat for support for energy programs, which I think is an interesting development. But I think probably on balance, the amount of, and I think as being reported elsewhere, whilst we do have the cost of any given national project can easily be 5 to 7% of a project's cost. The project preparation costs of regional are probably sort of much higher, at least 10%. But they may, whilst they are more challenging, if we've got creditworthy off-takes, say in an energy project, these larger projects may actually create more opportunities for international institutional finance, where one of the constraints is ticket size. It's not a completely negative story on regional projects. So in terms of our conclusions, others may have different views, but I think the conclusion that we have come to, and probably is the one that we started off with, that the main challenge here is indeed one of a shortage of bankable projects. Main reasons for that are risks often to our own revenue streams, whether it's quality of offtake or whether it's uncertainty over ability and willingness to pay. Some of the ways around this are, where, for instance, we have significant traffic risk, or whether it's off-take. We do see quite a role for PRGs, or at least we think that is something that should be considered pretty upfront in terms of when people are putting project concepts together. I think there is a question if the uptake on PRGs increases, are current IDA and ADF allocations sufficient for that, given what else they could be used for? Are there ways in which those resources could be supplemented? And then if we turn to looking at the challenges on the supply side in terms of introducing more local currency debt and money from international institutions. It's probably not just a case of products, it's probably also a case of how the development and finance community might actually operate slightly differently. Greater use of local currency is clearly going to create more opportunities for local investors and lenders. To do that, maybe we need to start moving away from, as far as possible, from a pure project financing model and look at more corporate financing solutions. if we're looking at local currency solutions, we probably have to accept that there will be additional costs of that, particularly in terms of interest or variability of interest rates, and there needs to be a way of passing those costs through. But that clearly is a hedge against exchange costs arising from exchange rate depreciation in most circumstances. As regards international investors, most, apart from specialist investors, a lot of the large institutions do need credit ratings. It's probably going to be easier if a project is operational. So again, if we want to bring this capital in, we need to start thinking about refinancing as much as initial financing. And this is a more natural entry point for investors. How do we do that? Well, maybe we do need to think about moving away from everyone coming in at financial close and bringing clubs of DFIs together, and thinking about how maybe we do need to finance things a lot more purely through DFIs in terms of debt, and donors may need to help risk share in that, and then really look to bring in institutional investors through refinancing. Anyway, that is the end of the formal presentation. So we're, I think, back over to Mohammed.
Thank you, Mark. This is a very interesting presentation. To our audience, we now have a set of questions through which Mark and Michael can hope to discuss their findings with you. So let's take a look at these questions for the next 10 minutes. You should see the first one on the screen now. It asks, which of the economic infrastructure sectors has attracted the least private finance over the period from 2004 to 2014? Telecoms, water and sewage, transport, energy. So Mark, it looks like most people say it's water and sewage.
I think that's pretty much a correct answer. I think that was probably the an easier one to begin with.
Let's see what the next question we have here is.
But I think it's worth saying that water and sewage, I mean, a lot of that is as much about a lack of opportunities in terms of the types of projects that investors would look to provide finance to. Although obviously a lot of the political economy issues are also pretty important there as well.
So we're seeing a few of the questions here. The next one is, what has become the biggest source of private finance for infrastructure projects? Institutional investors, donors, DFIs, or commercial banks? So like more than half have said it's commercial banks, and about a third have said it's DFIs, and some have said institutional investors. Your thoughts?
Okay, so yes, it's correct. I mean, we were quite surprised actually to see the commercial banks providing such a share of finance. And remember, the figures that we've quoted are for Sub-Saharan DFID-focused countries in Sub-Saharan Africa, outside of South Africa, and excluding telecoms. So this is, I mean, we know that telecoms now are pretty much financed purely by private sector sources. So this is, we are looking at the more challenging sectors here. It's fair to say that those numbers are, if we were to look at numbers of projects, I think it would be a different story. I mean, just by value, I'm just turning to Michael here, but I think it's the two Nigerian projects were particularly, which are particular. I think Lekki Deep Sea Port and IPP in Nigeria, particular drivers of those numbers. But as far as we can ascertain, most of that debt is bank debt. It's not from institutional investors. Although, where you may see institutional investors is if there is a private equity investment. A number of institutions have invested in private equity funds.
Okay, let's take a look at the next question. What type of finance is most typically not available for infrastructure projects? Private equity, grant finance, long-term currency finance, or long-term foreign exchange debt? Okay, so it looks like a majority have said long-term local currency finance, and there's a small set the other answers. Mark.
Yes, and again, that's correct. Long-term local currency financing, certainly in DFID's focus countries outside South Africa, and it should be one of the big points here is that the difference between countries such as India and South Africa, which we use as comparators in some of the more detailed research, all have long-term local currency finance markets for infrastructure. But once you move outside that, then there's very little that it's observed. The Lekki Expressway in Lagos being probably one example I think we came across where we did identify significant long-term local currency financing.
So on to the next question. What is the main challenge to mobilizing private finance for infrastructure projects? Is it lack of donor support, lack of a shortage of bankable projects, or Basel III restrictions?
And yes, that's the main.
So we see the majority is a shortage of bankable projects.
Finding. Obviously, the project is not bankable. There will be a shortage of long-term FX. Some local banks do have, particularly privatized, formerly state-owned banks, may find it more difficult to access wholesale long-term foreign exchange markets because of their own lack of creditworthiness and or ability to post collateral for such financing. But by and large, it is a shortage of bankable projects in these countries that is the current constraint.
Well, thank you, Mark. We're going to take a few questions from the chat screen. One question we have from Tapera Hove is there a country-by-country split in terms of lenders to the Sub-Saharan Africa? Which sources present the greatest potential for growth?
Yes, it is possible, I think, to see. You would have to analyse by projects to see which banks were lending where as regards countries and projects. But I think it's fair to say that a lot of the a lot of the FX financing is coming from, or the entities who are involved in its provision are, South African based. Some of the, whether it be sort of international banks or banks such as Barclays there with big international networks, or whether it be more like Nedbank or Standard Bank, and they will have teams of bankers who will basically look across the whole continent for opportunities. So it's really more from that perspective. It's more a case of, as I say, ensuring that the project is bankable, that it's known about, and finance will flow. A number of very good transactions in countries. A number of the locally based national institutions are also very keen to become involved.
Thank you. We have a question that came in by email earlier, and it asks, how has crowdfunding of securities from accredited or sophisticated investors, how have they been utilized to fund PPP projects in Africa?
I think we were unaware of any crowdfunding approaches. I think the closest we saw, and remember this is DFID focus countries, was I think some projects in Ethiopia had tried to raise finance through diaspora bonds, but as the presentation tried to point out, at financial close, it's not typically on the debt side. There's very little, if any, in these sectors, excluding telecoms. There's very little institutional investment that takes place. Most of the investment, most of the lending is either through DFIs or else specialist or commercial banks with specialist project financing departments. Not really crowdfunding for those long-term tenors. I don't think is a usual. Well, we had no evidence of that being a source of finance. It might be at a more micro level, but we didn't look at that.
Okay, thank you, Mark. Question from Jemima. On the refinancing idea, how would you see this affecting pricing? And since typically DFI funding is longer and cheaper than private institutional investor funding, how would you see the structuring happening to avoid a lack of motivation?
Sorry, you're cracking up a bit there. I think this is definitely challenging. I think what we understand happens with DFI funding is that funding costs or pricing will typically be the same from financial close across the life of the project. So it's essentially the costs are annuitized. That compares often with project financing banks in the commercial world, who will be more likely to charge, for instance, interest during construction. So it's a more risk reflective pricing, particularly during a more risky construction period. Clearly, it's important to recognise that DFIs need to make a return on their capital. Their sponsors, like governments, don't want them falling over. So I think there would need to be quite careful thought about how a model would work in which a DFI was able to make its return, once an asset does become operational, then the financing cost should reduce, either on pricing or through higher gearing. This can work. Both factors can be at play. But I think it's something probably that. I don't think it's something that would necessarily happen to existing assets. I mean, I know there's a lot of pressure from various sources for the DFIs to essentially securitize their portfolios to create opportunities for institutional investors. I think the approach that we're suggesting might be considered further is one in which at the initial financing it was always the intention for DFIs to exit, and obviously they might need some equity kicker to benefit from that. It's not straightforward, but I think without if you don't have that approach, then you need to think, if you want to attract, if it's important, if it's seen as being attractive to attract institutional investors, then there needs to be in the West, where there has been investment in greenfield assets, say PFI in the UK. A lot of the time, the senior lenders were basically had access to monoline insurers, most of whom went bust or shut up shop during the global financial crisis. So that's less of an alternative route that's available.
Thank you, Mark. Ron Williams asks about early stage equity. Wouldn't it be a solution to the shortage of projects with more funding behind the development of bankable projects? And did you have a look at where this type of money would come from?
Yes, I mean, what was interesting, what we did largely actually in renewables, renewable generation projects, but we did come across, when DFIs invest in early stage equity or pre-financial close equity, that's typically through IFC has InfraVentures, PIDGE have the Private Infrastructure Development Group have Infraco in Africa as a specialist vehicle. Some DFIs, like the Norwegians, NORAD, will actually provide equity, late stage equity for at the latter end of the project cycle for projects. What we did note was that a number of private equity funds now, whereas historically they were just kind of in at financial close, are coming into the project earlier in the cycle, in the late stage, and providing resources to get the project over the line. And I think that's a very interesting area to explore as to whether or not greater availability of finance in the later stages of the project cycle, pre-financial close, could be catalytic in terms of advancing projects. And so I think this is a wider question in terms of it would be interesting to explore in terms of the overall development and finance model. Are there alternative ways of doing it which could be more catalytic, notwithstanding the fact that any DFI providing finance needs to do so in a way that meets their respective financial requirements.
So Mark, Hero is following up on your and Jemima's discussion on refinancing. She says, I think that Jemima's question relates to the idea that DFIs cover the construction phase and refinance with private financing. But such DFI financings are substantially cheaper than market financing. Longer terms, borrowers would have no incentive for finance. The only way would be to agree upfront that private refinancing would be mandatory once peer group milestones are met. But that would be something new to DFIs and very sensitive in terms of client relations. Do you have any comments on that?
Yeah, I mean, I think I think it is a very sensitive issue. I mean, what is an appropriate level of pricing for DFI finance? There's a range in that financing. Does it? Its objective is to be catalytic. At the same time, it shouldn't be crowding out private finance. So, I think it's there may be ways in which, as I think the interesting question is if you actually looked at the risk profile over the project life cycle, what is the appropriate, what is more of a market benchmark for that? And I think there may be questions around whether DFIs should be just pricing everything at the same level. I think in reality, what we came across in these markets was that there was a lot of DFI money around, driven by this shortage of projects. Given that there's a lack of project financing opportunities, DFI is being pushed by their shareholders to operate more in these markets. It's perhaps understandable that there's pressure on pricing in a downwards direction rather than upwards. Very little pressure we saw in DFIs to recycle their balance sheets, which is obviously a lot of commercial banks where facing capital shortages would do. Maybe African Development Bank, I think, probably has more of a need to do that. But I think it runs to the heart of what is the role of development financing. Is it one in which DFIs make money and then reinvest, and obviously they have to do so on a sustainable basis, or is their role very much in trying to be catalytic and create markets and bring in new lenders and investors to these project opportunities? And clearly, there's a mix of both. But I think maybe a question of balance in terms of what should they be doing the same thing in all circumstances?
So Mark, thank you for your response. We're arriving near the end of our webinar. I think we'll take one more question from email. So here's a question on from Swetal Sindbad. What are the key risks that need to be managed in a partnership for water supply infrastructure?
Wow. I mean, obviously, water projects are much more politicized than a lot of other transactions. I think it's fair to say that in general, where we're seeing private sector participation, it tends to be in the non-customer facing aspects of infrastructure outside cellular telephony. So water, clearly the whole issue of how how services are paid for, who pays is critical. If tariffs have got to increase over time, how do you do that? Clearly, customers are looking, don't want to be paying more for a level of service that they've been experiencing historically. Are there ways in which you can tie increases in tariffs with an associated improvement in delivery of service? Well, and at the same time, making sure that there's always a very pro solution alternative that those who can't afford to pay those tariffs are able to go to. But it is a highly problematic area, and within this research per se, we didn't really focus massively on water, given the fact that there was less. It is so much more challenging.
Well, thank you so much, Mark, and Michael as well, for being here today and taking the time to discuss your report. I think I speak for everyone attending when I say it's been a pleasure having you with us.
Thank you.
I also thank the audience. You've been extremely engaging. Great questions, great follow-up questions. We'll be sending all the registrants a link to the presentation. as well as a link to the full report. There's been a lot of questions about that, so that will be included. We'll be sending it within 24 hours, along with the recording, which will also be available online. As a reminder, this webinar is the first of a 4-part series on infrastructure and PPP financing. The World Bank Group is hosting this webinar every Tuesday at the same time. Next week, we'll be hosting one on PPP financing trends in India. So please join us next week, same time, next Tuesday, hear from Sharmila Chabali from India's Ministry of Finance. And before you go, we have a short survey presented to you. We hope you can consider taking the time to complete it. It will help us provide better webinars for you in the future. And thank you again. We look forward to hearing your feedback.